The U.S. housing market in 2025 isn't just slowing down, it's in full-blown collapse. Cities once known for booming real estate and economic growth are now turning into financial disaster zones, leaving homeowners and investors watching their equity vanish. Million-dollar homes in San Francisco are losing $200,000 in value almost overnight. Florida property owners are crushed under sky-high insurance premiums, topping $8,000 a year. Meanwhile, Detroit streets remain filled with vacant homes and foreclosure signs. Housing inventory is skyrocketing, price cuts are everywhere, and foreclosures are quietly rising. Desperate sellers are slashing $50,000 to $100,000 off their listings, and still can't find buyers. This isn't a market correction. This is a housing market crash. Here are the 10 worst U.S. cities for real estate in 2025, where owning a home may be a one-way ticket to financial ruin. Number 1. San Francisco, California. The investor's worst nightmare. San Francisco, once the crown jewel of U.S. real estate, has become the ultimate housing market disaster of 2025. Median home prices remain an eye-watering $1.4 million, yet values have dropped nearly 12% year-over-year, erasing billions in equity. Inventory has surged 25%, leaving luxury condos and single-family homes sitting on the market for 75-plus days, a stark contrast to the bidding wars of 2021. The affordability crisis is brutal. Median household income is roughly $136,000, but a mortgage on a $1.4 million home at 7% interest costs over $9,200 per month, far beyond what most buyers can handle. Tech layoffs, remote work, and mass corporate downsizing have fueled an exodus, leaving downtown office vacancies above 30% and crushing confidence in the city's future. Rentals offer no relief. Average two-bedroom rents hover around $3,700, well below ownership costs. Strict rent control laws limit annual increases to about 3%, while property taxes, HOA fees, and soaring insurance costs bleed landlords dry. Investors betting on Airbnb income are getting hammered as tourism lags and new short-term rental regulations slash profits by up to 30%. Meanwhile, crime, homelessness, and shuttered retail stores have driven over 50,000 residents out in the last 3 years, further weakening demand. San Francisco in 2025 is no longer a gold rush. It's a financial graveyard. For investors, it is the worst real estate market in America, where even million-dollar bets are guaranteed to burn. Number 2. Houston, Texas. Oversupply and investor. Payne, Houston, long considered the energy capital of the world, has become one of the most challenging real estate markets in 2025. The median home price sits around $340,000, but rising 30-year mortgage rates near 6.9% push monthly payments close to $2,250, straining households with average incomes of just $72,000. The city's once famous affordability advantage is fading fast. Housing inventory has surged 25% year-over-year, and homes now sit on the market for an average of 52 days, nearly double the 2022 pace. Sellers are slashing prices by $15,000 to $40,000 to get attention. Investors face a unique problem: oversupply. Houston's construction boom has left thousands of new builds priced between $400,000 to $500,000 sitting unsold. Builders are offering massive incentives like $20,000 buyer credits and mortgage rate buydowns, undercutting private sellers and squeezing profit margins. Rents aren't keeping up either. A typical 3-bedroom home rents for about $1,950 per month, well below carrying costs, leaving landlords in the red. Property taxes are punishing. A $340,000 home racks up over $6,800 annually. And insurance costs are soaring, with wind, hail, and flood coverage exceeding $4,500 per year in some areas. Economic volatility adds another layer of risk. Energy sector layoffs, rising office vacancies, near 28% downtown, and declining business confidence have chilled demand. In 2025, Houston's real estate market is oversaturated, expensive to hold, and increasingly risky. turning what was once a growth powerhouse into an investor minefield. Number 3. Detroit, Michigan. The investor's money. Detroit has long symbolized urban decline, and in 2025, it remains one of the worst cities for real estate investment in America. Median home prices hover between $80,000 to $90,000, some of the cheapest in the nation. But low prices don't mean profits. Nearly 20% of homes sit vacant, creating widespread blight and crushing neighborhood values. Rental yields look strong on paper, with median rents around $1,100 to $1,200, but the reality is harsh. Tenant defaults, slow evictions, and constant repairs quickly wipe out returns. Many homes are 70-plus years old, requiring thousands annually in upkeep. Investors who buy multiple properties at bargain prices often watch all of them bleed cash. Detroit's population decline is relentless. The city has lost nearly 40% of its residents since 1950, and the current population sits near 620,000, down from over 700,000 just 15 years ago. This steady exodus means housing demand stays weak, and long-term appreciation is nearly non-existent. Carrying costs are crushing. Property taxes are among the highest in the U.S. An $80,000 home can owe $2,800 annually, plus insurance costs that have jumped 15% year over year. Crime remains a major deterrent, with violent crime rates near 2,000 per 100,000 residents, scaring off buyers, renters, and lenders. For investors, Detroit in 2025 is a cash-burning trap. What looks like a bargain market hides high risk, low reward, and collapsing resale values, making it one of the most dangerous places to invest in U.S. real estate. Number 4. Baltimore, Maryland. The real estate trap of 2025. Baltimore might look like a bargain with a median home price of just $220,000, but in 2025, it's one of the most dangerous traps for real estate investors. On paper, affordability should be strong with household incomes averaging $58,000. Yet the city is bleeding residents and struggling with some of the highest vacancy rates in America. Nearly 15% of homes sit empty, with certain neighborhoods topping 20% vacancy, leaving landlords paying mortgages with no rent coming in. While median rents average $1,500, many tenants struggle to pay. Eviction processes are slow, and aging row houses demand constant maintenance that eats away profits. Property taxes are punishing, costing about $2,600 annually on a $220,000 home. One of the highest effective property tax rates in the U.S., rising insurance premiums, up 15% in 2 years, only add to investor pain. But the biggest factor driving the decline is crime and depopulation. Baltimore's violent crime rate sits at 1,900 per 100,000 residents, more than triple the national average. Entire zip codes are avoided by buyers, trapping investors in properties they can't resell. Even homes purchased during the 2021 boom for $180,000 are now reselling for closer to $160,000. A backward slide that signals negative appreciation. In 2025, Baltimore has become a textbook case of why cheap real estate isn't always a good investment. A city where profits vanish, values sink, and investors get stuck holding the bag. Number 5. Portland, Oregon, housing market collapse, 2025. Once hailed as the West Coast's eco-friendly paradise, Portland's housing market in 2025 has turned into a financial trap for homeowners and investors. The median home price sits around $520,000, while the average household income is only $78,000, a severe housing affordability crisis. With 30-year mortgage rates near 7%, monthly payments exceed $3,300, far outpacing wage growth. Rental yields have plunged below 4%, meaning landlords are losing money every month. Investors who banked on appreciation are finding the opposite. Home prices are falling 8 to 12%, and inventory has surged over 15% year over year. Properties that once sold in days now sit for over 40 days, forcing desperate sellers to slash prices. Rising crime, homelessness, and high property taxes are further eroding demand. Downtown office occupancy has dropped below 55%, devastating local business confidence. Operating costs are climbing, with property taxes topping $6,200 annually and insurance premiums jumping 20% in fire risk zones. Oregon's strict rent control laws cap increases at around 7% plus inflation, trapping landlords with rising expenses and limited revenue. For investors, Portland is no longer a safe bet. It's one of the worst housing markets in America for 2025, where equity evaporates and cash flow disappears. What was once a hip, booming housing hub has now become a real estate money pit. Number 6. Cape Coral, Florida. From boomtown to bust, Cape Coral, once the poster child of Florida's housing boom, has turned into a nightmare for real estate investors in 2025. Home prices, which skyrocketed over 70% between 2020 and 2022, have collapsed. The median price has dropped from $435,000 to $395,000, a 9% year-over-year decline, with inventory up nearly 40%. For sale signs now dominate entire streets, signaling a full-blown buyer's market. Houses sit on the market for 75-plus days, triple the pace of the pandemic frenzy. Affordability is in crisis. With median household income near $68,000, the monthly mortgage on a median home is nearly $2,800 at 7% rates, out of reach for most buyers. Foreclosures are surging, up 20% this year, and many sellers are taking $80,000 to $100,000 losses compared to what they paid just 2 years ago. Insurance costs are crushing homeowners. Property insurance bills run $6,500 to $8,500 annually, with flood and hurricane premiums climbing even higher after Hurricane Ian. Many insurers have left Southwest Florida, forcing owners onto expensive state-backed plans. Property taxes add another $6,000 a year, making carrying costs unbearable. Rental income doesn't save the math. Long-term rents average $2,100 to $2,300, well below break-even, while short-term rental markets are oversaturated with thousands of Airbnbs fighting for fewer tourists. Cape Coral's Florida dream has turned into a real estate disaster zone, with plunging prices, soaring costs, and investors trapped in negative cash flow. Number 7. Fort Myers, Florida. The tide has turned sharply. Fort Myers was once the poster child of Florida's post-pandemic boom. Investors flocked here when prices surged nearly 60% from 2020 to 2022. But in 2025, the tide has turned sharply, and it's ugly. The median home price, which peaked near $420,000, has already dropped to $370,000, a 12% year-over-year decline, one of the steepest in the nation. Homes are piling up on the market with inventory up nearly 30%, and sellers are slashing prices by $20,000 to $50,000 just to get offers. The affordability crisis is glaring. Household incomes average $70,000, but at today's mortgage rates, the monthly payment on a median home sits at $2,650, far beyond local budgets. Investors who bought at the top are underwater, and foreclosures are creeping back. In fact, foreclosure filings in Lee County spiked by 18% this year, raising fears of a repeat of the 2008 crash that devastated this region. Insurance is the dagger. Florida's property. Insurance premiums have exploded with Fort Myers homeowners, now paying $5,800 to $7,500 annually, double what they paid just 3 years ago. Some insurers have pulled out entirely, leaving owners scrambling for coverage. Add to that the lingering scars of Hurricane Ian in 2022, and buyers are hesitant, pushing prices even lower. Rentals aren't much of a savior either. Average rents sit at $2,000 to $2,200, far below the cost of ownership. Many Airbnb operators are seeing occupancy rates collapse as supply outpaces demand. Investors banking on quick flips or passive rental income are discovering Fort Myers is bleeding cash instead of printing it. Once hailed as Florida's hot spot, Fort Myers is now a glaring warning sign. Oversupply, collapsing values, and punishing insurance costs have turned it into one of the worst markets for real estate investors in 2025. Number 8. New Orleans, Louisiana, America's financial storm zone. New Orleans, once celebrated for Mardi Gras parades and jazz-filled nights, has become one of the worst real estate markets in 2025. Median home prices have plunged from $300,000 to $265,000, a 12% year-over-year drop that looks like a deal but hides a financial trap. Mortgage rates near 7% push monthly payments on modest homes close to $1,900, swallowing nearly 43% of the average household income of $53,000, far above the affordability threshold. The real crisis is insurance. New Orleans faces extreme hurricane and flood risk, and premiums have exploded. Homeowners now pay $7,500 to $10,000 annually, plus $1,500 to $2,500 in flood insurance. Many insurers have exited the region, forcing property owners into costly state-run programs. For investors, cash flow is underwater. Median rents for three-bedroom homes hover around $1,600 to $1,700, leaving landlords deep in negative territory after taxes, maintenance, and insurance. Vacancy rates top 20% in some neighborhoods, as storm damage and disinvestment drive residents out. Safety is another major red flag. Violent crime rates are more than double the national average, deterring renters, homebuyers, and even tourists. Tourism, New Orleans' economic lifeline, has slowed, and short-term rental owners report income drops of 25 to 35% compared to just 2 years ago. New Orleans has turned into a perfect storm of risk: falling property values, soaring insurance costs, rising vacancies, and declining tourism, making it one of the most dangerous housing markets for investors in 2025. Number 9. Punta Gorda, Florida. The Florida housing market trap. Punta Gorda, with its postcard-worthy Gulf Coast views, seems like paradise. But in 2025, it's one of the worst real estate markets in America. After peaking at $410,000 in 2022, the median home price has crashed to $368,000, a 10% year-over-year drop, making it one of the sharpest housing declines in the country. Inventory has jumped 35%, and sellers are slashing $25,000 to $60,000 from asking prices just to get buyers' attention. Homes now sit on the market for 70-plus days, a far cry from the pandemic boom when they sold in a weekend. Affordability is in free fall. With median household incomes around $65,000, the monthly payment on a median home now tops $2,600, out of reach for most locals. Foreclosure filings in Charlotte County have spiked 22% this year, reviving memories of the 2008 crash. Insurance costs are the final nail in the coffin. Florida home insurance premiums have doubled since 2020, and Punta Gorda is one of the hardest-hit markets. Homeowners often face $7,200 plus per year, plus $1,500 to $2,000 for flood coverage, if they can even find a provider. Many insurers have left the state, forcing residents onto expensive state-backed plans. Rental math is no better. Average rents of $1,900 to $2,100 don't come close to covering costs, and short-term rental oversupply has sent Airbnb occupancy down 25 to 30%. In 2025, Punta Gorda's housing market collapse is a warning. Paradise can quickly turn into a financial nightmare for investors. Number 10. Carlsbad, California. Real estate nightmare. 2025. Carlsbad, famously known as the Village by the Sea, was once a Southern California real estate dream. Luxury homes, ocean views, and thriving tourism. But in 2025, it has become one of the worst housing markets for investors. The median home price is $1.27 million, yet the median household income is just $115,000. At today's 7% mortgage rates, the average payment on a Carlsbad home is nearly $7,800 per month, pricing out even high earners. Rental income isn't saving investors either. Average rents hover near $3,200 a month, barely covering half of carrying costs. Housing inventory has jumped 20% year over year, and luxury properties now sit on the market an average of 65 days, up from just 21 days during the pandemic boom. Desperate sellers are slashing prices by $200,000 to $300,000 just to get offers. Investors counting on short-term rental income are being crushed by California's new restrictions and stiff hotel competition. Vacation rentals that once earned $80,000 annually are now making closer to $50,000. Meanwhile, costs keep rising. Property taxes on a $1 million plus home exceed $12,500 per year. Insurance premiums have jumped past $6,000 due to wildfire and flood risk, and HOAs in luxury communities add $400 to $600 monthly. Carlsbad may still look like paradise, but for investors it's a cash flow disaster, and one of the riskiest housing markets in America for 2025. The collapse of these markets isn't just a set of numbers, it's a warning for every investor and homeowner in America. From San Francisco's crumbling luxury sector to Detroit's endless vacancies, the data paints a clear picture. The U.S. housing market in 2025 is more dangerous than ever. Whether you're an investor looking for opportunities or a family trying to protect your home's value, staying informed has never been more critical. So, what do you think? Are we witnessing a short-term correction or the beginning of a housing market meltdown that could rival 2008? Let us know in the comments. We read everyone. Don't forget to hit like, subscribe, and turn on the notification bell so you never miss a daily update. We'll be back every day at the same time with fresh insights and the latest news. See you in tomorrow's video.